I understand we have Mayuresh Joshi joining us. He's fund manager at Angel Broking. Good afternoon, Mayuresh. Good to have you. We are seeing a sharp reversal from the day's high point. Do you see some support at 7,800 holding out?
Good afternoon. Not really sure whether support exists technically. But really, I think if you look at the entire perspective of what has happened since yesterday, I think a whole host of transparency will come through in the long run. So in the short term, the hot money flows will have an impact in terms of how the market movements might gyrate. So I think the volatility will continue, not just in terms of how the global cues are panning out, but generally I think the earnings season has been quite reasonable so far. So my own take is that the market
And we have Mayuresh on a bad line. We'll try and patch that for you. But as of now, as the markets are evidencing that 78.93 was the high point, we are down significantly. The banking counters are to blame for as far as the fall is concerned right now.
Pranoy, just a little bit, because you've been tracking, of course, the markets very carefully, and there's been a lot of speculation in terms of any kind of knee-jerk reactions we'd be seeing on the repercussions of what we've seen in terms of the tax treaties with Mauritius. You know, what is your sense in terms of how the markets are behaving today?
Fatima, it has been quite volatile. I mean, the SGX in the morning was indicating a down move of 120, 130 odd points, which was possibly a little stretched. So post which we saw a sharp recovery and almost a 100-point up move that we saw on the Nifty only in the first 40 to 50 minutes of trading. Post that, we almost attained parity, reached the 7,900 level, but true to what has been playing out of the last several sessions, 7,900 has been a real resistance zone, which we haven't succeeded to clinch beyond. And 7,900 and 8,000, the writing in the option space seems to continue there, because even despite the strong up move, there was no short covering that started on the 7,900 call. A, that, and B, even the contribution wise movers, the bank Nifty has taken a cut for the worse. So owing to that, now we are at near 7,800, but there is some support that is still there at a 7,700 and a 7,800 level for now. Fatima?
And we still have some hours of trade ahead of us. Pranoy, I believe we have our guest Mayuresh Joshi back with us. He's a fund manager at Angel Broking. Mr. Joshi, apologies for the line earlier on. Just a quick sense from you as to what you're reading in the markets right now.
Afternoon, Fatima. I think the volatility will continue for the better part of this series, to say the least. What happens thereafter would be largely dependent on how monsoons pan out. And again, the market's perspective is that if the monsoons are far better, the rural incomes, the rural discretionary spending will start coming through, which can be seen in the second half. Second half is also the period when a lot of market participants are of the belief that the earnings recovery, along with the capex recovery, might start being evident in terms of the macro data that is available. Having said that, probably what has happened yesterday with the Mauritius tax treaty, I think the hot money probably can have huge amount of impact as far as the short-term flows are concerned. But the government move is highly recommendable, and again, I think the transparency that it will bring is largely quite good for the Indian markets from a long-term perspective. And again, it is largely well spread out, right? It's going to start from April 1st, 2017 with some riders over the next 2 years. Again, I think GAR, which is expected to come through, I think largely the markets are expected that to come through. So clearly, I think what we're seeing probably is a knee-jerk reaction, but the government moves very, very positive in my opinion. The right steps being taken in terms of imposition of taxes. And again, I think the transparency that will bring to the system shall be far greater for the Indian equity markets going ahead. And India anyway stands in a very sweet spot compared to the other emerging banks.
Fair enough. Mayuresh, just hold your thoughts for a bit. We'll move on to another big story that we have been tracking, and we received news flow from the courtrooms, and in what comes as a huge relief to telecom companies. The Apex Court has struck down TRAI norms on the call drop penalty. The Supreme Court has called the TRAI's regulation on call drops as arbitrary and non-transparent. Ashpreet Sethi joins us with more details there. Ashpreet?
Big relief coming in for telecom companies from the Supreme Court, especially with the court saying that the TRAI regulations as far as call drops penalty is concerned, it is arbitrary, non-transparent and ultra-virus. In fact, the Supreme Court has set aside the TRAI regulation. Remember, the Delhi High Court had upheld TRAI's powers to go ahead and levy this kind of penalty on telecom companies. However, the Supreme Court has turned that around. In fact, we'll have to wait and see whether the government goes ahead and rectifies its norms as far as call drops draft penalty is concerned, remember the TRAI norms earlier had said that telecom companies will have to pay 1 rupee to consumers per call drop with a cap of 3 rupees per day per customer. But of course, with this, there's a huge relief coming in for telecom companies. Kapil Sibal, who was representing COI and OSPI, the two associations, had told the Supreme Court that companies will have to shell out thousands of crores of rupees if they were bound to give this compensation. So we'll have to wait and see what step does the government take next, but we'll get you updates as to what does the judgment exactly say once it's uploaded on the website.
All right, thanks for that, Ashpreet. Mayuresh, coming to you, as far as some of these telcos are concerned, something like Bharti Airtel and Idea. In fact, if you pull up the stocks, they are back to almost parity levels. Something like Bharti Airtel is also down in the red after that short spurt that it saw just soon after the verdict. But Mayuresh, capex-heavy businesses, also we saw the kind of downtick that we saw when the call drop penalty case, the details of it came out. But in terms of longer-term prospects, would you maintain and avoid as far as this space is concerned on back of the higher finance outgo, given the kind of auction undertaking that has been committed by these companies, and till the time at least Jio makes an entry and the dust settles down in terms of competitive intensity?
Again, largely these facts are well known by the markets. What you've been seeing in terms of how numbers are coming out for these companies, the voice traffic growth is increasing, but the realizations in terms of ARPU are going down. Secondly, in terms of even the data volumes, the data volume growth has been quite substantial for a company like Bharti. Probably disappointed in case of Idea because it went for pricing rather than volume growth, specifically on the data front. But what happens with the Jio launch is that the volumes might get offset with lower amount of pricing coming through for a bigger bite, specifically on the data revenues. Now again, I think the call drop issue, it's largely done with, that could have had an impact if it would have gone adversely against the telecom companies to the extent of 4 to 5%. So to that extent, I think the telecom companies have just stated the news. But it's back to square one. It's back to the capex programs that these companies are pursuing, the kind of network costs that they need to entail going forward, the kind of spectrum-related costs, specifically on the 700 megabands, which is close to 11,200, 11,300 odd crores for that band. I think that is going to have a huge implication if companies do bid for that. They're already having high leverage balance sheets. The kind of capex programs that a lot of these companies have announced will ensure that the cash flows that come out over the next year will largely remain constrained. So again, I think numbers will be very, very interesting to watch out for, specifically Q1, Q2 for the telecom companies. So I think an equal weight rating at this point of time, I think I'm not seeing substantial upside. So I think they'll at best be market performance going ahead.
All right, Mr. Joshi, I'm just going to come to you. We were just talking about telecom, but let's get into the media space itself, because we saw that Zee Entertainment made quite a stellar operating performance in Q4. We understand that both top line and margins beat estimates. Lower other income, in fact, and higher tax rates restricted profit growth. But let's get in some more numbers through my colleague Hiral, who's here to really break down those numbers for us. Hiral, first to you.
That's right. A spectacular set of numbers wherein in terms of the top line as well as the margin front, a clear beat. However, the profit number was slightly below estimates. Now, in terms of where brokerages are concerned, Macquarie has maintained an outperform and they've increased the target price to 490 from a 470. And what they are saying is that Zee, if it has to significantly beat the 18% year-on-year ad growth estimate for FY17, and TV's performance will have to improve, and margins are expected to improve in FY17 despite the higher sports losses, and they've marginally tweaked their FY17 as well as 18 EPS downwards by approximately 2% each on account of a higher tax rate as well as depreciation. Credit Suisse has maintained an outperform for a target price of 475, and what they are saying is that they're expecting the EBITDA growth for FY17 to remain strong at above 20% levels, and they've tweaked their estimates with lower subscription growth leading to approximately a 3% cut in terms of where earnings are concerned, and they're saying that Zee will remain a key beneficiary in terms of where digitization is concerned. Goldman Sachs has a neutral and they've maintained the target price at 393, and what they are saying is that better margins have been offset by higher DNA as well as taxes, and they're expecting Zee to continue benefiting from ad market growth mainly driven by lower input costs from FMCG as well as higher spend from the auto as well as the telecom stocks, and digitization in phase 3 and 4 areas is likely to drive subscription revenues as well as margin expansion, and they've lowered their FY17 as well as 19 EPS by 3% on lower margin assumptions. Morgan Stanley has maintained an equal weight for a target price of 370, and what they are saying is, however good the earnings, the valuations are still expensive at 33.8 times estimates in terms of where price to earnings is concerned. However, the guidance for FY17 that the management has given is pretty robust. And lastly, we have UBS, which has maintained a neutral for a target price of 435. And what they are saying is that they are seeing high growth visibility, and they're expecting Z to benefit from viewership improvement as well as digitization. And they are forecasting a 15 to 16% CAGR in advertising as well as subscription revenues for FY16 to 19. And slower growth in content, selling and distribution expenses should aid EBITDA margins as well as profit growth expansion. So all in all, brokerages have not really changed their stance or target price. However, from a long-term perspective, they are very bullish in terms of the guidance that the management has given.
All right, Hiral, thanks a lot for that. I'm taking that back to our guest. Mr. just coming back to you in terms of what Hiral has just told us about the long-term perspective that these brokerages are looking at. What do you make out of what you've seen and also the management guidance?
A strong set of numbers, Fatima, and if you go by what the management is guiding for fiscal year 17, largely even if you assume that ad revenue growth in terms of 15-16%, because the last quarters had the base effect of ad TV as well, but that largely would be taken well by the market. Secondly, I think the subscription revenue growth, again in double digits, would probably entail that the digitalization phase 3 and 4 would be moving in the right direction at the right pace as well. We're probably looking at margins getting sustained because the content cost pipeline probably is much lower than what one really expects, and those post losses are expected to be a tad bit higher than what we saw in FY16. You'll see still have EBITDA margins being maintained at similar levels or even getting pushed up for FY17. Now what really stands out for Z is the commendable performance that it has shown this quarter, specifically in terms of how the subscription revenues have grown, and if that has substantial amount of traction going ahead, I think the consolidated numbers will be far better than what really one expects. The valuations are a little bit on the higher side, but my own take is if investors are holding on, you should hold on to a stock like Z. I think I remain optimistic on the stock, and a clear disclaimer, we might be holding this stock on behalf of our clients.
All right, so hold on to a stock like Z. Pranoy, I'd like to come to you because you've been tracking the next part of this very closely. We're looking at Hindalco's subsidiary Novelis, which we understand has posted a stable set of numbers in the fourth quarter. We understand enhanced productivity and increased automotive sheet shipments have driven those strong results. What more do you really have for us in terms of those results?
Well, it has been a strong performance, and mind you, it's important because it contributes 2/3 to the overall consolidated sheet as far as Hindalco is concerned in terms of the top line. Also a big contributor in terms of EBITDA. So if you talk about Novelis' performance this time around, the EBITDA has come in higher, $215 million as opposed to $180 million in the year ago period, and the net income has remained mostly stable, although revenues have gone down a bit, but operationally it is a strong performance. Geography-wise, even that is quite positive because the North American EBITDA has gone up. It has gone up by $26 million, is now close to $100 million as opposed to 70 in the previous year, and that has shown a big bump up. Even the South American EBITDA is $92 million as opposed to 68 odd million dollars in the year ago period. For Europe as well as Asia, there have been marginal improvements, and Europe here is the bright picture because Europe was the one that had dragged the EBITDA significantly 2 or 3 quarters back, so that seems to be reviving a bit. As far as the volumes are also concerned, the volumes across their shipped products, as far as total shipped products are concerned, have gone up incrementally for across geographies if you take a look at it, save for Asia, but still Asia has reported a stable EBITDA performance. Even if you talk about the house views on Hindalco, owing to Novelis' earnings, are mostly positive. There have been price target upgrades that have come in from something like an HSBC as well as a Credit Suisse. HSBC has raised the target to 100 from the previous 91, and they are positive, of course, on the outlook of the company. They say that sales to automotive industry continues to post strong growth, and automotive, mind you, has contributed 15% of the total sales, and the company has been quite positive on their sales vent as far as the automotive segment is concerned. The highest EBITDA on high volumes and improving mix, and the company has guided also for high volumes in FY17 is what they are betting big on. Credit Suisse, on the other hand, they maintain an outperform with the target raised to 115 from the previous 110, and North America, they say, contributed half of the incremental EBITDA, and they have raised FY17 to 18 estimated EBITDA for Novelis by 7 to 8%. So that's quite a positive view coming in. As far as brokerage are also concerned, the stock is up more than 2% ever since opening in today's session. Mayuresh, let's come to you as far as Hindalco goes. Novelis is a key contributor as far as their earnings are concerned. Even in terms of their domestic business, a lot of their capex is behind them. Aditya and Mahan are ramping up successfully and adding to those aluminum and alumina volumes. How do you see the earnings trajectory panning out for something like Hindalco? The operational costs are typically higher, but that will also like normalize going ahead in terms of finance costs and depreciation. In terms of aluminum spot premiums, that has also possibly bottomed out 2 quarters back, and even Vedanta's operational aluminum performance was quite stable. So do you expect something similar from domestic Novelis performance, Hindalco performance?
Domestic performance, if one really goes by the past few weeks and quarters, with improvement both in terms of aluminium as well as alumina prices, the expectations is that with increased volume growth as the management is pegging going forward, we will have an improved impact in terms of how the top line grows. Secondly, I think with the kind of cost structure that Hindalco has at the current juncture, with utilization levels picking up, the leverage probably starts coming on to the operational performance of the company as well, and that will have a positive impact in terms of how EBITDA margins are expected to perform. So largely, I think the domestic performance, if the conditions remain extremely robust, if the capex cycle turns better over the next few quarters, is expected to improve. And again, I think the end user industry is something that we need to closely track out for in terms of how the demand has probably come through over the past few months and expected to come through over the next few months. Novelis performance extremely commendable at this point of time. And again, largely, I think the auto component specifically as part of their overall contribution is expected to increase from the current 15 to say 20-25%. If they're successfully able to do that over the next few quarters, the EBIT contribution there would be far greater. So again, I think it all depends on how the operational performance of the company will be, both in terms of auto performance for Novelis and the domestic volume growth along with improved realization for the aluminium and the alumina business, specifically for Indian operations.
Okay, I'd just like to come in at this stage in terms of some earnings that we're still expecting, and that of course includes the fact that we're really watching out for Kotak Mahindra Bank's earnings that come out today. We understand that the private lender is expected to post a steady quarter. Shraddha, of course, has been tracking all of this, and she's here with a review, a preview, I beg your pardon. Shraddha, over to you.
Well, yes, it's going to be the fourth quarter for Kotak Mahindra Bank to report those merged numbers with ING SBI Bank. So numbers not strictly comparable on a year-on-year basis, but it's expected to be a pretty steady quarter. Overall, focus is going to remain on the merger or integration costs. They should start coming down this quarter. In fact, it could in all likelihood just be the last quarter where we see some of those merger and integration costs coming in, or probably could taper off slightly in April. In terms of the key numbers, net interest income is seen at 1,833 crores. Net profit is seen at 670 crores. Net interest margins were likely to see a small pickup on a Q-on-Q basis on the back of improving CASA profile, and also as we're expecting integration costs to and other expenses to come in slightly lower, at least on a sequential basis. Loan growth expected to be at about 15%, of course, mainly retail driven. No major pressure as far as asset quality is concerned, so slippages are expected to remain under control with gross NPAs seen in that 2.3-2.4% range. Credit costs also to remain within that guidance of 80-85 bips for FY16. So important to watch out for the performance of the non-banking subsidiaries and their contribution to the overall profit, and also the growth in savings account balances and commercial vehicle book will be important. But overall, a steady, stable quarter for Kotak Mahindra Bank.
Shraddha, thanks for that. I'm coming back to Mayuresh Joshi on that. Mayuresh, you just had our colleague Shraddha really looking out for what we're watching out for in those earnings in terms of specifically the factors that you're looking out for. What are the factors you're going to be watching out for? And I'd also like to ask you for your view really on the banking sector itself.
Well, largely for Kotak Mahindra Bank, advances growth expected to be between that 14.5-15.5% range. You're probably looking at deposit growth anywhere between 15 to 16 odd percent. Now, as Shraddha was mentioning, largely I think the markets are just stating stable NIMs to come through anywhere between 4.3 to 4.4 odd percent. You're looking at asset quality remaining stable. GNP is around that 2.3-2.4% mark. Net NP is around 1%. The management commentary around the integration with ING is going to be extremely crucial, because last time round they had identified around 6% of ING's books as stressful. So how much of that book is expected to go under stress is going to be extremely crucial. What kind of retail growth one expects in terms of advances and deposits going ahead as well is going to be crucial as well for the bank, and the sustainability of maintaining the NIMs. Credit costs again largely expected to be between that 80-85 bips range that the management was talking about, and any improvement thereof will be taken positively. Valuations again on the higher side, so I think everything will depend on how the management outlook is and how the subsidy performance will be. On the private banking space, I think we remain extremely optimistic, though a few of the private sector banks, specifically retail oriented, have moved up quite substantially and valuations have become a little bit stretched. My own take is that the banking industry as a whole, specifically on the retail side and the private side of the banking space, should do well over the next year and a half, and we are still expecting earnings growth in excess of 20% with strong capital adequacy coming through, with strong branch network. Our own take is return ratios, both in terms of ROAs and ROEs, should stabilize and improve going ahead as well.
All right, fair enough. In keeping with earnings, let's also focus on Asian Paints, another big one on the radar today. A strong set of numbers expected from the consumer major. Shell joins us with the street expectations. Shell?
Right, so when you're looking at Asian Paints, overall the company's revenue growth is expected to come in at 10.5%. Company's profits are expected to see a very big jump of almost 28%, and also margins are expected to expand by 140 basis points. Why such a positive quarter? The first thing is that most analysts are expecting a very strong volume growth of anywhere between 11 and 12%, and this is one of the higher volume growth which is estimated as compared to the other FMCG companies. Besides that, also the tailwinds as far as raw material costs are concerned are expected to come ahead and benefit the quarterly earnings. All crude related raw material costs are expected to come down, and that's clearly on the back of lower crude prices. Also, one other important thing is that in the month of March, the company had gone ahead and taken a 2% weighted average price cut. So what kind of impact that has is also be quite important to watch. Besides that, any kind of commentary coming in from how their products are done in the rural markets will be important, and any kind of commentary on further pricing actions will also be one thing to watch out for.
All right. In fact, Mayuresh, I'm just going to come back to you because Asian Paints, of course, being one of the results we're also looking out for with regards to the rural markets themselves. Just before we go into a break, your sense of what we can expect from those earnings as well.
No, I agree largely with what Shil was saying. 10-11% volume growth is what one really expects to come through for Asian Paints, entailing a 10-11% top line growth. The margins would largely again be between that 17.2-17.5% kind of range. We've seen sharp fall in crude prices. Titanium dioxide has seen a sharp fall on a year-on-year basis by 7.5%, and that will have a positive impact in terms of how margins pan out. But largely, I think it's going to be more volume driven at this point of time. We've already witnessed a 2% cut in the decorative segment where it is a market leader, but that impact in terms of volumes will play out more meaningfully in the June quarter because it was largely taken a month and a half back. What happens with management commentary specifically in relation to how the repainting demand is expected to pan out for rural tier 2, tier 3 cities as well as the urban demand is going to be extremely critical. What happens on the industrial side of business is going to be extremely critical as well in terms of what expectations are basically getting laid out in terms of volume growth thereof as well. In terms of valuations, I think richly valued at this point of time, but it's always traded at a premium. So I think all these numbers in terms of volume growth, the expectations of management commentary, the demand outlook are going to be extremely crucial for a stock like Asian Paints.
All right, Mayuresh, thank you so much for joining in. We'll leave it at that. We'll be watching out for, of course, crucially Kotak as well as Asian Paints. Both stocks are marginally higher in trade today. Well, up ahead, we discussed changes in the Mauritius tax treaty with Manish Singh of Crossbridge Capital and Daksha Bakshi of Khaitan & Company. Keep watching.